time for a stock review. In fact, this time we're comparing ETFs. We're looking at QQQM, Invesco Exchange Traded Fund ETF, Invesco 2, a NASDAQ 100 ETF versus the S&P 500. Which one should you buy? Well, we're going to do a test, and we're going to we're going to work out which is the best to invest in. So first of all, we're going to show you a back test against the S&P 500. We're going to look at the valuations of each VOO and QQQM, and we're going to have a look. We're going to come to a conclusion which one is the best. Look at the expense ratio and so on and so forth. Now, because this is an ETF, we're not doing a normal review. It won't be as long as a normal review. There won't be the intrinsic valuation and the balance sheet and stuff like that, because it's tracking. It's an index tracking fund, so it's tracking the stocks inside it. So we need to, if you want to know how Apple's performing, you look at Apple's balance sheet and so on. This is not about that. This is tracking those stocks. So which one would you invest in? This was requested by Namisha, one of our members. We're Members Week this week, and we're doing all your reviews, live Q&A, questions. You can phone into the show. The show is now live. I'm making this during a live stream. The link is pinned into the chat. Tap the like button if you're watching this later. You're also going to be able to get all my links to become a member, so you can have a review like this, or you can also get my software that I'm going to use in this stream for free trials, free discounts and all sorts of stuff. And when you go premium and pro as well. So consider subscribing, supporting the channel as we work towards 100,000 subscribers by our 4th anniversary, which is in just 3 months' time. So which one would you invest in? Well, let's have a look at it. We're going to break down each one, and then we're going to look at the results, and then you can decide which way to go. So before we start, we need to understand what is an exchange traded fund. Well, it's an index which tracks certain stocks. So rather than owning individual stocks, you can own a basket of one stock which tracks the performance of the stocks held within it. So it's an exchange traded fund. That way it gives you an exposure to a broad sector of stocks, and the ETF can be all kinds of things. It can focus on a certain industry or even just a single stock, actually. But mainly you buy an ETF because you want a basket of funds in a certain sector or a certain index that you're interested in. And it's either actively or passively managed, depending on the cost of it. And someone is paid. You don't physically pay them, but it comes out of when you sell your stocks. A small percentage, you won't even notice it, but it'll go to that part will come out of your profit when you sell your positions to manage the fund. Now, some are actively managed, which means they're actively trading all the time and making lots of alterations to the fund, and some are passively managed, like the S&P 500, where 6 months or 12 months they go in and adjust the fund, but that's it. They're not sitting there trading or doing options. They're just leaving it alone. All right, it's just tracking the performance of of the stocks in that index. So the S&P 500 is regarded as the benchmark. It has the history. It's Warren Buffett's favorite, even though he's recently sold all his position, but it was only 0.01. It wasn't any big deal anyway, but that's one of his favorite things to own. If you just own the S&P 500, you own the best 500 companies in the United States, and over time, you'll do okay. These are for long-term investors. They're designed to, you buy and hold. You might want to trim along the way, take some profit out of it if you've been doing it for years, but you're not in and out of this every 5 minutes. Yes, traders do that, but that's not what they're designed to do. You can do that, of course, but it's not what I do, but others do. So let's just look on the S&P just for a minute. I've actually got 100% of my portfolio in the S&P. I've got 500 shares on the S&P in my main account, and 70 on my Roth IRA. So 570 shares. But that's not important. You can see it's down today. We're getting all this volatility. You can see that the maintenance requirement is 25%. So if you're buying on a margin, that's the lowest level. Well, let's compare that to this one. Let's see what the margin position is when you buy it. It says down here somewhere. I probably just already skipped by it. I missed it somewhere. Why kind of not? That's strange. Why is it not on there? Oh, it's because it's in my brokerage account in my Roth IRA. I'm going to have to do one at a time then. Otherwise, I'm going to be backwards and forwards. So this is 25%. If we can remember that, maintenance requirement, 25%. I think we don't need to go into too much detail what the S&P 500 is. I think most people know, but it's all to do with allocation. This tracks the top 500 companies of the S&P, and you can see we've got technology at the top, 31.99%. So it is tech heavy, but it is not overweighted in tech. Tech is important, but it then also features very highly financial, then consumers, and then healthcare, and then down the list it goes. But technology is 31%, and that's going to give you a clue here, because when we look at this one, we know the NASDAQ is very tech heavy. So this fund, which tracks that, is no surprise. If we scroll down, it has 104 holdings, by the way. It's 51% tech. Very much more, doesn't focus at all on the financials. Now, the financials for me are the future right now, even though they're under pressure with crypto. The financials are outperforming. They were outperforming until the tariffs came into play. But I think the financials are going to be the outperformers of the market. This index doesn't have it. Crypto is the future. We want an ETF that tracks the financials, in my opinion. You might not like the risk and the stress of it, but I do. So straight away, this is not one I would own. It's very similar, other than financials. If it had that and it reduced that and brought its technology down, it would be very similar, I would imagine. Look, pretty close, 31%, 15. You can see it could get pretty close to the S&P. So it's mainly focusing on tech, taking away financial. For me, tech I think is important, but I want financial as well. So this is not one for me. If you like, I mean, some people have both. I'm not sure. There's too much point in having both. You know what you like, you go with what you like. I know people do, but then some people have the S&P 500 and they have the global ETFs, then they have the NASDAQ, and it's kind of like, you kind of mix them all up. And it's like, if you like tech, you go NASDAQ. If you like tech even more and no financial, you go for QQQ. If you like a balanced approach with all the main sectors, the S&P, and I do, to be honest. That's the strength of it, because it's also its weakness. Its weakness is its strength. If one sector fails, another one performs. That's why I like the S&P, and it's got that track record. So I don't think we should all be heavily weighted in tech, in my opinion, anyway. But overall, does it balance out? Well, let's have a look. Let's scroll down here a minute. So we know the allocation is more weighted towards. That's got the financials on the S&P, and the QQQM doesn't have the financials. It's more tech. So straight away, what are you more bullish on? More tech or some balance with the financials included? Well, I've just told you what I think. You can do what you think there. This won't matter about volume and all these things. We don't really care about this. What we do care about, though, is the expense ratio. The expense ratio is 0.03. All right, it's one of the lowest, if not the lowest ETFs of this quality. So the expense ratio of VOO is the best. So that, the money you're making, you're keeping nearly all of it. And that's important, because that adds up when you get a $1 million portfolio. It becomes something, all right? The PE ratio is 28. It's expensive. If we go over and look at the QQQs and we scroll down, and let's have a little look. What does it say here? 35 times earnings. Now, why is it more expensive? Well, because tech is more expensive, and it's got an expense ratio of 0.15. So again, don't like it because it hasn't got financials. Don't like it because it's more tech heavy. Don't like it because it's more expensive. Don't like it because expense ratio. 4 reasons there that I prefer VOO over QQQM. And I don't see a reason why to have both. If you want both, you just buy some more NVIDIA. Yep, you buy the S&P 500 and you buy NVIDIA and Apple. Now you've got more tech without the fees, much better PE ratios, much better fees. That's what you do. In my opinion, the way to do this would be own VOO. If you want more tech, you simply just buy Apple and NVIDIA. The two best, that's it. You can just buy, 10% of your allocation just goes into VOO, goes into Apple and NVIDIA. You've achieved the same thing, but without the fees and the expense ratio. So I would do that because the expense ratio of NVIDIA is way below 35. So that's what I would do. So straight away, I'm making it pretty obvious the way I think of QQQ versus S&P. But that's no surprise because I own the S&P. If I thought this was better, I would own this, wouldn't I? So it's kind of obvious which way I was going to go anyway. But I hope to prove that I wasn't being biased. The facts were the facts. Okay, now that's all very good. We know now that what it costs. We know the expense ratio. We know it's more tech heavy and so on and so forth. We know the PE ratio is not as good. But now let's look at its performance, because if it's more expensive but performs well, doesn't matter, does it? Right? And when it comes down to it, it doesn't, does it? So if you like this so far, please tap the like button and consider subscribing if you're watching this later. If you're watching this live, of course, you're already a member and you're watching it live. Namisha, who ordered the review, one of our members, said, that makes sense, Martyn. That's the advice I was looking for. Well, it's a simple one, really, this one. But again, let's look at the performance. It's all very well saying, well, it's cheaper and it's this and it's that and the other, but does it perform better? Well, let's have a look at it. Let's take a look, first of all, at VOO, and we look at its momentum. Well, it's great. No, obviously, it's great. We know it's best performance stock in the world. I mean, an ETF, it's the benchmark. That's why I own it. So no surprise, I'm owning a quality stock. I mean, this is quite funny, really, making a review on what I own, because I'm only going to buy a good stock, right? I'm only going to buy a stock that performs well. Imagine me showing you the stock that I've got $300,000 in, 100% in on everything, every penny I own, including selling my own gold card today to buy more, and yet all this was rubbish. I mean, you think I was mental, right? It would be like, what's going on here? Are you mental? But I don't think I'm mental, but you never know. Anyway, so there you go. Very good. All A's, pluses, A minus, pluses, plus. Oh, great. What about the QQQs? Well, not quite as good. Pretty good. But there's a few B pluses, B minuses. Higher risk. Dividends are lower. Well, of course they're lower. The tech stock doesn't earn any dividends, so you're going to get less dividends. It's obvious, because when you put more into tech, NVIDIA doesn't have it. Apple's are tiny. You're going to get less revenue from those stocks, so you're going to get less dividends. That's why it's B+. This is all kind of obvious. I like making reviews like this. Dividends, A. See, on VOO. I like this because this is kind of like telling me, yeah, you are buying the right stock. Yep, carry on. It's the best review I've ever made. Yeah. Oh, I feel good now. Thank God for that. I knew there was a reason why I bought the S&P 500. Anyway, let's do a back test. This is the performance now of the stock, because all this means nothing if the results are it makes more money to own QQQ, right? Well, let's go and have a look. The back test. You put $10,000, and bearing in mind, this is from 2021. QQQM, 2021. Let me see back here. Yeah, inception date 2021. So we can't go back to the beginning of history like we can with the S&P 500, right? In fact, let me just check a minute. QQQ, all there. 2021, 2020. Yeah, 2020. Yeah, only a few years we can go back. We can't go back that very long. That's just the way it is. All right, I'm just double checking that. We put $10,000 in. Now, Invesco QQQ is in blue and the S&P 500 is in green. So you see sometimes you're ahead, sometimes you're behind. Reminds me of the song Sunscreen by Baz Luhrmann. Go and listen to that. It's great. Sometimes you're behind, sometimes you're ahead. What can I say? Someone just said to me it outperforms. The actual reality is it doesn't outperform. You can see there the QQQs are slightly behind. Slightly. Do you care? Well, I think the financials are going to outperform. I think tech's being sold off. Well, it is. It's happening right now, which is why it's coming down. Long term, does it make a difference? This includes adding the dividends in. This includes just automatic reinvesting. So you put in 10 grand in the NASDAQ, you got 16.6, 16.7. Does it matter? No, it doesn't. The S&P wins. If we have to pick a winner, it wins. Because at the end of the day, you've had more for your money, you've had slightly better value, you haven't got the risk of the tech, you've got also in financial, which I think is the way forward. Does it make a difference overall? No. If I was giving, which I am, giving my honest opinion, I think it's obvious what I would do. You simply ask yourself this question and you have the answer. The S&P 500 has a great track record over time. This is a much newer thing. Tech, AI is much newer. Is it going to fail? Well, if it fails and AI starts to sell off, you're in trouble if you own the NASDAQ or you own the QQQs, right? Obviously. Whereas staples and other things are financials, well, they're not going anywhere. You might think, well, crypto, that's going to be an extra catalyst for financials as well, like I do. Another reason to own the S&P 500. The expense ratio is lower on the S&P 500. The performance is slightly higher on the S&P 500. The cost basis to own the asset is slightly better on the S&P 500. If you particularly like tech and you're not that bothered about financial, the way to fix that would be, I think there is only one outcome and conclusion to this, based upon facts, not emotional and personal choice. It would be you own the S&P is better than the Qs, no doubt about it. However, if you are really bullish on Nvidia and Apple, they're the leaders of the S&P. They're the ones that are going to buy up any AI that pops up, and they'll just swallow it up. So the expense ratio for those is better because you haven't got the cost basis to buy the stock. First of all, it's not part of an ETF. The PE is better. I would simply, if you were pro tech, you buy the S&P and you add some Apple and Nvidia. So there you go. I think the S&P, I know on numbers and facts and that amount of history that we have, and S&P is better. I also believe going forward it will be better with the financials and not the heavy risk on tech. But if you still like the idea of the Qs, you just simply buy the S&P and buy an individual allocation of Nvidia and Apple and Broadcom or whatever you fancy. That's going to give you the same result at a better price. I think that's a fair review of it. Or you could look at the NASDAQ, but that's another review for another day. It's a different thing altogether again. There's my review. And Namisha, who ordered the review, said, that makes sense, Martyn. That's the advice I was looking for. Cedar Trees is commenting, VOO is up 227% in 10 years. QQQ is up 392 in 10 years. Yes, but we're looking at QQQM. We're looking at the stock that Nimisha wanted to compare. QQQM is what we've just done. If we type in here, we can look at another one. Not for now, though. QQQ, the Qs. That is a different thing altogether. Okay, we were looking at the QQQM today. So there we go. Very helpful, Martin. Thank you very much indeed. I appreciate that. There you go. That was another review done. Click above my head for all the links. I enjoyed that one. Feel good about that. Now I can live with all this decline. Go below in the description for all the links to Alpha Spread and Seeking Alpha. Those watching it live now, there it is. And the membership links and everything else. And over here, I shall put the Seeking Alpha review. I've done nearly 300, nearly 200 stocks, nearly 200 reviews up here. And down here, I shall put the playlist for, what would it be? In fact, it won't be a playlist for this stock. It's an ETF. So it'll be something I think you would like down there. Until next time, as always, take care of yourselves and each other.